Thank you, Roger, for very kind words of introduction. Although I must say that Peter Matterson and Frans Timmermans, who were sitting next to me, rightly pointed out that normally the commissioners are much more humble than the heads of cabinet in the European Commission. So, ladies and gentlemen, it's a great pleasure to be here with you this afternoon, here in the heart of the city. There are few issues that could be of greater relevance to Europe's leading financial center than the twin topics of today's conference, the prospects for revival in the Eurozone or of the Eurozone, and Britain's future in Europe. This is a subject about which I speak with particular interest, as I have a special relationship with Britain. I have a great affinity and affection for this country. My mother was an English teacher, and she came to England as an au pair to study the language sometime before I was born. But my father was also here on his summer holiday. And I have a degree from a British university. Two of my cousins have British passports, and I am a lifelong supporter of Manchester United. Since I played at the age of 6 for Man United in the European League of my hometown in 1968. We had some rough decades in the 70s and early 80s until Sir Alex came to helm, and we've done quite well since then. Anyway, I'm an equally strong supporter of Britain being fully and actively engaged in the European Union, a union of which Britain is indeed an essential part. Let me, however, begin by talking you through with the rebalancing underway in the Eurozone economy. The current picture is quite dualistic and can be summarized like this. We have disappointing hard data from the end of last year, some more encouraging soft data in the recent past, and growing investor confidence in the future. I know that since the Italian elections, Italy is, as Roger Little referred to already, Italy is on many, if not all minds here as well. And I can just say that the Italian people have made their democratic choice. The picture that has emerged from these elections is, of course, a complex one. But we have confidence in the Italian institutions and in the ability of President Napolitano to swiftly chart a way forward to ensure that Italy can continue to address the challenges it still faces in consultation with the country's political forces and in line with Italy's constitutional requirements. It is, of course, important that Italy pursues reform for the sake of sustainable growth and job creation. Italy is an important founding member of the European Union, and the Commission will continue to work in a close partnership with Italy in order to support it in facing these important challenges. In recent months or half year, say, since the Olympic Games here in London, the confidence in the Eurozone economy has stemmed from important decisions taken in recent months by both Eurozone member states and European institutions, not least by the European Central Bank. These have helped to calm markets and banish fears that the integrity of the euro is at risk. Far-reaching structural reforms are helping to reverse current account imbalances in the Eurozone as competitiveness lost by some members in the decade before the crisis is being regained. As John Maynard Keynes noted before the Bretton Woods talks, such adjustment, such rebalancing is compulsory for the debtor nation and voluntary for the creditor nation. Keynes, of course, knew what he was talking about because he was representing the interest of a debtor nation in the Bretton Woods talks in 1944. But this does not invalidate the case for a more symmetrical external rebalancing within the Eurozone involving creditor as well as debtor countries. And that's why the Commission has recommended that surplus countries should implement reforms to strengthen domestic demand. For instance, Germany should do this by opening up its services market and by encouraging wages to rise in line with productivity. Two recommendations made to Berlin by the EU Council and Commission last July. And there are signs that domestic demand is strengthening in Germany, and the latest round of pay agreements in 2012 last year settled on rises of almost 5% on average in Germany. We should also be aware that the Eurozone is neither a small open economy nor a large closed one, but instead a large open economy that trades a lot with the rest of the world. Fortunately, trades a lot with the rest of the world. This means adjustment channels are influenced substantially by global economic interdependence, and I think it's important to take into account that a reduction of surpluses in the north will not lead automatically to a corresponding increase of demand for exports by the south. In fact, the first and foremost beneficiaries of stronger and greater German demand would be the Central European economies that are closely integrated into Germany's supply chains. A Commission analysis suggests that a 1% increase in German domestic demand would improve the trade balance of Spain, Portugal and Greece by less than 0.05% of gross domestic product. This would not get us very far. This analysis is relevant in view of the academic debate about fiscal consolidation versus fiscal stimulus, which is quite lively at the current juncture. Academic debate always has the potential to enrich the making of economic policy, and policymakers should always be open to have their ideas challenged. Debate is welcome, in other words, but there is also a risk in simplifying complex situations to make them fit with a preferred political narrative. For there is no single issue movement alone, be it fiscal discipline alone or debt mutualization alone, that can solve this crisis. Fiscal discipline alone would suffocate growth, while debt mutualization alone would lead to an unsustainable moral hazard. There is no silver bullet. If there were, believe me, we would have already fired it. That's why we need to continue our comprehensive crisis response by the Eurozone, by the European Union, and intensify and adjust it as necessary. Especially, we need to build bridges between the stability culture of the North and the solidarity culture of the South, and find well-functioning solutions that reflect the need for both stability and solidarity. And it is not only an economic and social imperative, it is a very fundamental political imperative in the deeply integrated Europe. In that context, when considering the calls for fiscal stimulus, we need to be aware that countries at risk of losing or having lost market access or paying prohibitive costs for their sovereign funding because of excessive deficits and debt burdens simply do not have the luxury to choose between consolidation and stimulus. The only choice they face is to restore sustainability to their public finances or to not to do so and face rising borrowing costs with all their negative ramifications for the real economy, for growth and employment. While I am not sure if Keynes himself would consider himself a Keynesian today, at least an unreconstructed one. I'm in fact a Keynesian myself, if that is measured by one's belief in the dangers of a liquidity trap and the rationale of counter-cyclical economic policy. In other words, once you have room for fiscal maneuver, you can pursue counter-cyclical economic policies with targeted investment for growth-enhancing purposes like innovation and infrastructures, as Sweden is doing today. But I also live in the real world under the shadow of a confidence crisis and of public debt at 90% on average in Europe. Even Germany's public debt exceeds 80% of GDP today. And this is a world of hard choices, imperfect policy options, a still fragile financial sector, intense market pressure, and political and financial constraints. And in this real world where we operate, Europe is getting its public finances back on track. Deficits in the Eurozone have fallen from around 6% of GDP on average 2 years ago to around 3.5% last year, and we forecast the average deficit will drop below 3% this year. Still deficit, clearly, and still in the scale of 2.5% on average in Europe. However, while deficits are being reduced in Europe, public debt is expected to stabilize only by next year, and as I said, to do so at above the level of 90% then. And serious empirical research has shown that at such high levels, public debt acts as a permanent drag on growth. That's why fiscal consolidation needs to proceed at a carefully but steady pace that is appropriate for each country. The Stability and Growth Pact that is appropriate, that focuses on improving the underlying budgetary position, takes out the effects of the, or neutralizes the effects of the economic cycle and of one-off fiscal measures. And from the point of view of rational economic policy making, this focus on structural sustainability over the medium term is the right approach, and it is the one we are committed to pursue. We have demonstrated this commitment last year when extra time was granted to Spain, Portugal and Greece to correct their excessive deficits. In parallel with this consistent commitment to sound public finances, Europe needs to embrace structural reforms to deliver the growth and job creation we so urgently need. This means tackling bottlenecks to growth by creating a growth-friendly business environment with better access to finance and simple rules to do business. Europe needs more entrepreneurs and businesses that are hungry and able to grow. In my view, the focus on fiscal policy alone is a much too limited view when trying to trace the reasons for slower than anticipated growth in Europe. Where is the primary problem then? I would seek it for the moment in the excessive tight financing conditions for businesses and households, which are caused by the still unfinished repair of the financial system and banking sector. Today's liquidity trap is in fact a financing trap, which Europe suffers from. The excessively tight financing conditions, especially in southern Europe, like Spain, Portugal and Italy, are hindering the flow of credit to households and businesses, and thus suffocating economic activity and export growth in these countries. While the United States, by and large, proceeded with the financial repair in 2008 and 2009, which was crucial to its recovery, this process in Europe is still only partially achieved, which is working as a critical drag against returning to recovery. That's why we need to urgently complete the repair of the financial sector in order to unblock private investment. And even if we are here in the city, I can tell you that this is not about bailing out bankers. It is about letting the credit flow to create growth and jobs in Europe. We also need to do even more to boost productive investment by the means of public sector, especially because we have not yet completed the repair of the private financial sector. Public banks such as the European Investment Bank has an important role to play here with its capital increase. And we must also look beyond our borders for growth by embracing a forward-looking and proactive trade policy. In Europe, about 30 million jobs, or more than 10% of the total workforce, depend directly on sales to the rest of the world, as Peter Mandelson, who fought valiantly for free trade as Trade Commissioner, knows very well. The recent initiative by the EU and the United States to launch negotiations for a comprehensive and deep free trade agreement is of enormous importance in this regard. It has huge economic potential to boost growth and huge strategic potential to revitalize the transatlantic partnership. And that brings me to the question of Britain in Europe, because it is in everyone's interests for Britain to be an active player on these important policy initiatives and in Europe in general. This is a game in which if I were a British citizen, I would want my country to be playing as a midfield playmaker rather than watching from the sidelines. No one has ever scored goals sitting on the bench. For 40 years now, Britain has been stronger thanks to its membership in the European Union, more dynamic economically, more equitable socially, more influential in world affairs. And to illustrate Europe's importance for Britain, I think Dr. Simon Sweeney, who is a lecturer at the University of York, hit the nail on the head when he wrote as follows: What did the European Union ever do for us? Not much, apart from providing 57% of our trade structural funding to areas hit by industrial decline, cleaner beaches and rivers, cleaner air, lead-free petrol, restrictions on landfill dumping, a recycling culture, cheaper mobile charges, cheaper air travel, single market competition bringing quality improvements and better industrial performance, freedom to travel, live and work across Europe, funded opportunities for young people to undertake study or work placements abroad, and so on and so forth. I must stop here to quote him for the sake of time, as he listed dozens of other things that the EU has brought for Britain. But he pointed even better by saying that all of this is nothing compared with its greatest achievements. The European Union has for 60 years been the foundation of peace between European neighbours after centuries of bloodshed. If it furthermore assisted the extraordinary political, social and economic transformation of 13 former dictatorships, now EU members since the 1980s, we must play a full part in enabling the Union to be a force for good in a multipolar global future. End of quote. That's the point. And the European Union is indeed stronger today because of Britain's tremendous contribution to it. Our economy is more open and dynamic as a result of Britain's liberal instincts, which are an important counterweight to the regulatory reflex which still sometimes surfaces. The single market we have built together owes a lot to those liberal instincts, but let's be clear about one thing. The single market needs rules, regulations and strong and effective institutions in order to function. Without those, there is no single market. Prime Minister Margaret Thatcher understood this well when she signed the Single European Act and then had it ratified in the UK. Whatever choices Britain ultimately makes about its future in Europe, I trust this great European country will support the rebuilding of our economic and monetary union in line with Chancellor George Osborne's political maxim that the remorseless logic of monetary union leads to greater economic union. Dear friends, ladies and gentlemen, we have before us many far-reaching choices in the Eurozone and in the wider European Union. In that context, I believe it is firmly in Britain's interest to use its energy for reforming Europe rather than seeking to undo our community, which would leave us all weaker, all in Europe, including Britain. In a nutshell, why not focus on reform rather than on repatriation? Let me conclude by referring to a former Prime Minister who told the House of Commons in 1967 that British membership in the community would be healthier for Britain, advantageous for Europe and a gain for the whole world. He was right on every count, and I can only agree wholeheartedly with his next remark. I do not know of many economic or political problems in the world which will be easier to solve if Britain is outside rather than inside the community. So, dear friends, let's move forward together. Thank you very much for your attention.